QuickBooks Pro Plus Desktop 2022 OneNote presentation, Invoice, Selling Inventory. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introduction 7100, Invoice, Selling Inventory. Also take a look at the immersive reader tool, topic introductions in the text area 2, same name, same number, but with transcripts. Transcripts that can be translated into multiple languages and either listened to or read in them. They have the same name and number as presentations as well, topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations and can be used to follow along with them if you do not have access to the software at that time. Closing the icon on the left-hand side, we're starting out with the trial balance. We're looking at the creation of an invoice. We're going to then look at the invoice created for the customer of Anderson 116 billing 2 area here. The items then are the things that are going to be driving what accounts will be impacted by the invoice. We have 3 items that are going to be listed out, or 3 rows of items, those being 3 pieces of different pieces of inventory. The ELP, a type of guitar, 5 of them, rate 500, that gives us the 2,500. We've got one of the EPRs, they cost $550 for $550, and an EPSH for $400, one of those for $400. What's going to be the transaction behind this? It's going to be an invoice. Accounts receivable is going to be then going up by the total amount, 3622.5. The revenue going up by the sum of these 3 items, not including the sales tax. The sales tax, including the sales tax payable, a liability account. There will also be a decrease in inventory and increase in cost of goods sold for an amount not on the invoice, but driven by and known by the software through the items. Then if we go back to the trial balance, we can then look at the accounts that would be impacted, which would include the accounts receivable, the inventory, the sales tax payable, the sales, and the cost of the goods that are sold. If we go into, this is the accounts receivable, we see the invoice that has been created. There is the amount that's going to be including the sales tax there. Back to the trial balance. Then we're taking a look at the transaction by account for the sales. The sales breaking out the same invoice for 3 different items because we sold those 3 different units or components of inventory components. Back now to the profit and loss. If we take a look at the $3,450 in sales, comparing it to the cost of goods sold, these are the 2 accounts that would be impacted from the invoice if we sold inventory, and the difference between those 2 accounts, sales and the cost of goods sold, would give us the net impact on both gross profit and the net income. We're now looking at the customer balance detail. This is the supporting documentation for the accounts receivable, breaking out who owes us money by customer. We're looking here at Anderson Guitars, and we could find the invoice there as well. The 2422.5, 24122.5 should match what is on the trial balance if we're running this for the same date range. Here's the inventory valuation summary, this being a subledger type of report supporting the inventory amount on the balance sheet or the trial balance, breaking out the inventory items, the amount on hand, the price. This amount, $44,180, should be what would be found on the trial balance or the balance sheet. And then we've got the sales price over here, which is what would be populated on the invoice for the sales item. Making another invoice, this time for Jones Guitars. On 117, we're going to sell 2 items, a GI USA, one of them, it's a Gibson USA. They cost $380 each, and we're selling one for $380, an ELP, 8 of them, Epiphone Les Paul, $500 unit cost. That comes out to $4,000. What would be the result of this on the financial statements? Well, the invoice would increase accounts receivable by the total $4,599. Other side going to sales for these 2 amount, $4,380. Then we got the sales tax increase in the payable, sales tax payable of the $219. There's also a decrease in inventory, increase to the cost of goods sold by an amount not on the invoice but driven by the items. If we go to the trial balance, the accounts that would be affected, accounts receivable, inventory, the sales tax payable, the sales and the cost of goods sold, profit and loss, accounts impacted, the sales, the cost of goods sold, both of them going up. The net of the two of them, subtracting them out, would be the impact on both gross profit and net income. Here's the customer balance detail, where we're now looking at Jones Guitars, where we have the second invoice, this being a sub-ledger report backing up or supporting the accounts receivable line item on the balance sheet, or the trial balance bottom line number should still match to what is on those reports. Inventory valuation summary, now showing us what is left over in the inventory, this supporting the line item on the balance sheet or trial balance related to inventory. This number tying out to it, 40,676. Then we can take a look at the customer center. In the customer center, this might be an area that we can go to take a look at Anderson and Jones to track the information and the open invoices. That's one way that in practice you might be tracking that information. We can also go to the transactions tab in the customer center, look at the invoices, possibly then filter the invoices by those which are still open to determine the open invoices in that way. If we were to do this from an accounting standpoint, just in terms of debits and credits, we would have our trial balance here to start out with. This is the journal entry that goes behind the invoice, which is actually fairly complex. So we got the accounts receivable going up by the 3,623, and the sales are going up. This is actually our sales price that we're calculating this based on. This 173 is going to be 5% because we're assuming 5% sales tax. It's increasing, it's not going to increase the sales amount, this 173, and then expensing it when we pay the tax, but rather going directly to the payable, a liability account. And then, of course, we're going to collect from the customer both what we charged as well as the sales tax that we're required to charge. And if it's a perpetual inventory system, as we're thinking about in the QuickBooks system, tracking the inventory as we make the sale, there's also going to be an increase to cost of goods sold and expense account, and the inventory account is going to decrease. So if we go down, we can see the accounts receivable here was at the 20,005. It's going up by the 3,623, the full amount of the invoice to the 24,123. We can see sales down here is going up in the credit direction. So this is up in the credit direction because they're debits and credits, 3,450. And then we see the difference going to the sales tax payable of the 173. And then we also have the inventory here going down, 46,940 down by the 2,760 to the 44,180, and cost of goods sold going up by the 2,760. The impact on net income being the difference between the sales and the cost of goods sold being the 690 in this case. If we look at the general ledger, the accounts receivable was at 20,500, went up by 3,623 to 24,123. The sales tax payable went up by 173 to 173. The sales was at 0, went up to 3,450. Cost of goods sold was at 0, went up to 2,760. Inventory was at the 46,940. It went down by the 2,760 to 44,180. We have the subledger for accounts receivable. This was Anderson Guitars here. So they owed us 500 before. We now invoiced them again, 3,623, bringing the balance up that they owe us to 8,623. This plus this plus this plus this for the 4 customers adds up to 24,123 for the subledger, which would be like the inventory valuation summary in QuickBooks. It should tie out to the inventory account, which is right here, which is the 44, and it doesn't. Why? No, this is not inventory, accounts receivable. Accounts receivable 24,123, 24,123, and 24,123. Then we also have the subledger for the units that we sold. So each unit that we sold at this point, and the date was at, when did we sell these? 1/16. So we sold this one right here. We sold the ELPs, 5 of them, $400, 2,000. Then we had 71 minus the 5. We got 66 remaining at the 400, the 26.4. And then the other item then over here that we sold, looks like we sold one EPSH, one of those. We had 16, we're down to 15 at 320. And it looks like we sold one of these, possibly an ERP as well. So if I then adjust my subledger here and add up all the balances of the subledger after having decreased the ending balance, we come out to the 44,180, and that should match the inventory line item up top, 44,180 up top. Then we do this whole thing again with that second invoice. Once again, the sales price being the $4,380 this time. Sales tax 5% of it. That means we're going to have to collect $4,599. The inventory is going down by the $3,504, which would be tracked in our subledger, and the cost of goods sold going up by the $3,504. If we post that out, accounts receivable going up from $20,005. Now it's going up by those two transactions to 28222 up to 28,722. We see that the other side went to sales, and then we see the sales tax increasing, and then inventory is going down, and the cost of goods sold is going up. The net between these two activities is the net impact on net income for those two transactions. We were at accounts receivable in the general ledger of 24,123. It went up by 4,599 to that 28,722. We were at in the sales tax payable 173. It went up by the 219 to that 392. Sales was at 3,450. It went up by 4,380 to 7,830. The cost of goods sold was at 2,760. It went up by that 3,504 to 6,264. And the inventory finally was at 44,180. Went down by 3,504 to 40,676. The accounts receivable subledger now, we then sold the second one to Jones. Jones owed us before $7,500. It's going up by $4,599 to $12,099. If I add up all four of our customers in the subledger, that adds up to the $28,722, which should match our GL ledger, $28,722. If we look at the inventory subledger, now we sold these ones on 117, so it looks like we sold some of these ELPs, 8 of them. We had 66 of them minus the 8. We have 58 left over then at $400 to get to the 23,200. And we can do this across. We see what the other one that we sold. Here's one we sold here was a GI USA, one of them at 304. We had 6 minus 1. We have 5 left at the 304. If we add the ending balances all together, then we're going to come up to that 40,676, which should tie out to our ending balance in the general ledger, 40,676 in the GL as well.